All right, if you're watching this right now, don't click away, because something just broke in the global markets, and most people haven't processed what it actually means yet. Silver just ripped through the $120 level, not flirted with it, not tapped it, smashed straight through it. And it didn't take weeks or months, it happened fast. While most headlines are blaming safe haven demand, the real trigger is more mechanical than emotional. Stay with me, because I'm going to show you what just happened, why it matters right now, and how you can spot this pattern before the crowd next time. If you're holding precious metals, watching the dollar, or trying to understand why your portfolio just got a lot more volatile, you need to understand the structure behind this move. Not the hype, the structure. Before I explain what caused this move, let me slow you down for a second and teach you something most people never really internalize about markets. Prices don't move because of headlines. Headlines chase price. That's the first thing you need to burn into your brain. Markets move because of pressure building quietly, then releasing all at once. Think of it like water behind a dam. You don't notice anything day to day, then suddenly the wall cracks and the flood looks unexpected. But it wasn't unexpected. The pressure was there the whole time. Silver didn't wake up one morning and decide to go parabolic. This was pressure that had been building underneath the surface, while most people were distracted by stocks, crypto, and rate cut speculation. Now here's what you need to know about silver specifically. Silver isn't just a precious metal. It's a monetary asset, an industrial input, and a liquidity hedge all wrapped into one. That means when currency confidence drops, silver feels it. When manufacturing demand holds up, silver feels it. And when investors start looking for assets that can't be printed, silver feels it fast. That combination makes silver explosive when the conditions line up. And right now, they just did. So what does that tell us? It tells us this isn't a one-variable story. You're watching multiple forces converge at the same time, and that convergence is what creates these violent moves. If this is making sense so far, drop a comment below and let me know where you're watching from. I want to know if you saw this coming or if it caught you off guard. No judgment either way. Just trying to get a sense of who's tracking these patterns. Now here's what's actually happening, step by step. The primary driver is the US dollar breaking down. Not a little wobble, a real structural weakening as markets price in looser Federal Reserve policy ahead. When the dollar weakens, every dollar-denominated asset gets repriced upward automatically. That's the first domino. And I'm not talking about a one-day move here. The dollar index has been sliding for weeks, grinding lower as traders price in rate cuts, fiscal concerns, and geopolitical shifts that make holding dollars less attractive. Every tick lower in the dollar makes commodities, especially precious metals, more valuable in dollar terms. It's mechanical. It's not about sentiment, it's about math. The second domino is confirmation from gold. Gold clearing above $5,600 isn't just symbolic, it's institutional validation. When gold breaks out first, it tells you big money is reallocating, not speculating. Gold is the senior metal. It moves first when real money is shifting. Central banks buy gold. Sovereign wealth funds buy gold. Insurance companies and pension funds buy gold when they're worried about duration risk and currency debasement. So when gold punches through a major resistance level like that, it's not retail traders gambling. It's capital flows that have weight behind them. And silver watches gold. Always has, always will. So when the dollar drops and gold confirms, here's the cascade. Funds that track commodities rebalance. They're not making emotional decisions. They're following index weightings and momentum signals. Traders who were short silver for yield reasons scramble to cover. Think about it. If you were short silver at $95 because you thought rates were staying high and the dollar was staying strong, and now both of those assumptions are breaking down, what do? You cover. Fast. Physical buyers step in because they don't trust paper assets at that moment. Liquidity thins out. And then, price gaps higher because there aren't enough sellers willing to stand in front of that momentum. That's why the move feels violent. It's not emotion. It's structure. It's the mechanics of supply, demand, and positioning all hitting at once. But here's the part that should make you nervous if you're not paying attention. Silver didn't just break a price level. It broke psychology. $120 was a line people anchored to for years. Analysts set targets there. Resistance was drawn there. People had mental stops there. Once that anchor snaps, the market has to search for a new reference point. That's when volatility accelerates, both up and down. And that's when people who don't understand the mechanics get shaken out. Because once you're in no man's land above a major resistance level, the next move can be anything. You could see $140. You could see a flash crash back to $105. The range expands because the structure just changed. Now let me show you what very few people are talking about. This isn't just about silver or gold in isolation. This is about what happens when real interest rates stay compressed while currency confidence erodes. Real rates are yields minus inflation. When that number stays low or goes negative, holding cash becomes a losing trade. Holding bonds becomes questionable. And suddenly, assets with no counterparty risk start looking a lot more attractive. Silver has no counterparty risk. It doesn't depend on a government promise or a corporate balance sheet. It just sits there with intrinsic value. And when enough people realize that at the same time, that's when you get moves like this. This is the exact same playbook we've seen before. In the 1970s, silver didn't creep higher. It exploded after the dollar was decoupled from gold and inflation started running. The Hunt brothers get all the headlines for that era. But the real story was currency debasement and negative real rates. In 2011, silver didn't grind to $50. It surged when real rates went negative and currency confidence cracked after the financial crisis and European debt crisis. Central banks were printing, governments were spending, and people ran to hard assets. And in early 2020, gold and silver didn't wait for the recession headlines. They moved first in March and April when the Fed announced unlimited QE. Then the world caught up months later. Every single time, the pattern is consistent. Weak currency, falling real yields, geopolitical stress, and a rush into tangible stores of value. Every time those conditions converge, metals move fast, and they move before consensus feels comfortable buying them. The people who wait for CNBC to tell them it's safe are the people who buy the top. The people who understand the structure are the ones positioned early. And the larger story here isn't silver at $120. The larger story is confidence shifting. Confidence in fiat currency. Confidence in central bank policy. Confidence in the system maintaining stability. When that confidence wobbles, money moves. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this be a blow-off top? Absolutely. Could this be driven partly by leverage and short covering that reverses just as fast? Of course. Markets overshoot. They always do. And no, this doesn't mean silver goes straight up forever. Pullbacks will happen. Volatility will hurt people who chase blindly. That's the reality. Could some of this be speculative froth from retail traders piling in after seeing the headline? Yes. Could geopolitical tensions ease and take some pressure off? Maybe. Could the Fed pivot hawkish again and strengthen the dollar? It's possible. Here's the thing. It doesn't actually matter whether this move was justified by fundamentals or overdone by speculation. The mechanics are what matter. Price is what's real. And your job isn't to decide if the market is right or wrong. Your job is to understand what's happening and manage your risk accordingly. Focus on what you can control, which is understanding structure instead of reacting to emotion or trying to outsmart the tape. There are probably 3 types of people watching this right now. The first type already owns silver and feels vindicated. Maybe you've been stacking for years. Maybe you bought in the 20s or 30s and people called you crazy. Maybe you've been underwater on positions you took at $80 and you're finally seeing green. If that's you, listen carefully. Your job isn't to get greedy. It's to manage risk and understand that parabolic moves don't last forever. This is when you should be thinking about taking some profits, not adding leverage. This is when you should be tightening stops, not getting complacent. Enjoy the win, but don't let euphoria override discipline. The market gives and the market takes away, and it happens faster than you think. The second type is on the sidelines, feeling late. You're watching this move and you're kicking yourself for not buying at $95 or $105. You're feeling FOMO. You're thinking about jumping in right now because what if it goes to $150? If that's you, breathe. Late entries are how people get hurt. Chasing momentum without understanding structure is how retail traders blow up accounts. Your edge comes from waiting for structure, not headlines. Wait for a pullback. Wait for consolidation. Wait for a setup that makes sense. There will be another entry point. There always is. And if there isn't, if silver just runs away and never looks back, then you missed one trade. That's not the end of your investing career. Discipline beats FOMO every single time. The third type thinks this is all manipulation or nonsense. Maybe you think metals are antiquated relics. Maybe you think this is just a squeeze that'll reverse. Maybe you're a dollar bull who thinks this is temporary noise. I get that skepticism. But here's what I'd say to you. Price is truth in markets. You don't have to like it. You don't have to participate. But you do have to respect it. And if you're dismissing a 25% move in a major commodity as irrelevant, you're missing information the market is trying to give you. Here's the universal principle for all of you. Markets move in cycles driven by incentives, liquidity, and confidence. If you learn to watch those three things, you stop being surprised. You start seeing patterns before they play out. You start positioning before the headlines hit. That's the skill that separates people who survive markets long-term from people who get wrecked by volatility. So here's what I want you to answer in the comments. Are you positioned in metals right now? Are you on the sidelines? And what's your biggest question about what happens next? I read every comment, and I want to know what's on your mind. So here's where I stand. I'm not chasing silver blindly at $120, and I'm not dismissing this as noise. I'm watching three things closely. First, I'm watching the dollar. If it keeps weakening and breaks below support around 98 on the dollar index, metals stay supported. If the dollar finds a floor and bounces, that's your first warning sign that this move might be losing steam. Second, I'm watching real interest rates. If they stay compressed, if the 10-year Treasury yield minus inflation expectations stays low, the bid under silver remains. The moment real rates start rising aggressively, that's when precious metals get pressured. Third, I'm monitoring gold. As long as gold holds strength above $5,400, silver has structural backing. If gold rolls over and breaks down, silver won't hold up on its own. It never does. Based on my analysis, this move was mechanical, not emotional. The fundamental picture has shifted. Dollar weakness is real. Gold strength is real. Real rates are compressed and likely staying that way unless something dramatic changes in Fed policy or inflation data. The structure was building for weeks, and what you're seeing now is the release. If history rhymes and silver consolidates here rather than crashing back down, the move that follows could be just as violent to the upside as what we just saw. But I'm not making predictions. I'm watching structure. This move wasn't random. It wasn't hype. It wasn't just safe haven demand. It was the convergence of dollar weakness, gold confirmation, short covering, physical demand, and momentum funds all hitting the same asset at the same time. And whether this is the beginning of a larger breakout or a temporary spike that reverses, the lesson is the same. Learn to watch pressure build. Learn to recognize when multiple forces are converging. Learn to respect structure over headlines. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the charts yourself. Look at the dollar. Look at gold. Look at real rates. Form your own conclusions. But if you made it this far, you're someone who thinks critically and doesn't just follow the herd. That mentality will serve you well in markets, in investing, and in life. If you found this valuable, share it with someone who needs to see it. Subscribe if you want more breakdowns like this. And stay ahead of the noise. Think in patterns, not headlines. Stay sharp out there.